Thank you for standing by. This is the conference operator. Welcome to the Trilogy Metals Feasibility Study results for the Arctic Project conference call. As a reminder, all participants are in listen-only mode and the conference is being recorded. After the presentation, there'll be an opportunity to ask questions. To join the question queue, you may press star, then 1 on your telephone keypad. Should you need assistance during the conference call, you may signal an operator by pressing star and 0. I would now like to turn the conference over to Tony Giardini, President and CEO. Please go ahead.
Thank you, operator, and thank you all for joining us on our conference call to discuss the results of the feasibility study for the Arctic project. Before I get started, I'd like to draw attention to our cautionary language, which is contained in the presentation that is available and will be posted on our website once the call has been completed. I'd initially like to start making initial introductions of who will be participating in the conference call. That will be myself, Tony Giardini, President and CEO, Elaine Sanders, Chief Financial Officer, Jim Gowans, who is a Director and was the interim CEO, is on the call and will be available to answer questions. Bob Jacko, our VP Operations, is on the call, and Pat Donnelly, VP Corporate Communications and Development, is also available to answer questions. So with that, I'd like to start the presentation, and we are on slide number 5. And slide 5 highlights the consultants that we used in carrying out this feasibility study. The consultants are the same consultants that we used for the PFS, which was completed in February 2018. Osenko Engineering Canada focused on plant and infrastructure design. Woods Limited focused on mine design and mineral reserve estimates, and SRK focused on tailings and waste management and hydrology and water management. We had other consultants that were involved, and all of those details will be provided when we file our 43101 technical report with all of the information available from the studies. Next slide, please. I'd like to just provide a brief overview of the results from the feasibility study. But before I do that, I want to speak a little bit about the history of this feasibility study and how we got to where we are today. We initially completed a pre-feasibility study in February of 2018. That study was actually based on work that was carried out in 2017. After we completed that study, which was a very robust economic result, we commenced our feasibility study and we moved forward directly into the current FS study that we've carried out. Now, we carried that study out before South 32 had exercised its option to become a joint venture partner in Ambler Metals. And South 32 at the time was funding exploration associated with our Bornite project, and effectively they funded $30 million of exploration over a 3-year time period. And they had the option to form the joint venture with Trilogy, but that option hadn't been exercised at the time. So when we started the work, we had done it strictly on a Trilogy basis. I'd also like to point out that as a result, this is a Trilogy study. South 32 has not been involved in the study, nor have they reviewed the study, nor has Ambler Metals conducted any review of the study. But I'll speak a little bit more about what happens next with this information and how it sort of feeds into the work that Ambler Metals will be carrying on as we move forward. But let me first talk a little bit about what the results of the study are. We're very excited about how the economics have held together once we move from a PFS to an FS. As I indicated, the PFS was carried out in 2017, so essentially 3 years have passed since that time. And yet, when we look at the economics, they continue to be extremely robust. We have a pre-tax NPV of approximately $1.5 billion. We have a post-tax NPV of $1.1 billion. We've run the numbers based on current spot prices, which were as of August 18th, and they indicate a 1.8 pre-tax MPV and a 1.1 or $1.3 billion post-tax MPV. Those are all run at an 8% discount rate. And then the next steps for this study is that it will be used by Ambler Metals as they move forward in doing optimization and other study work as necessary to advance the project. The study is being carried out on the basis that we're looking at a 10,000 ton per day operation. It would be an open pit mine with an expected 12-year mine life, but we'll talk a little bit more about the opportunities that we believe exist in the district to extend the mine life well beyond the 12-year time period. But for purposes of the study, we have focused on the reserves and resources that have already been identified at Arctic, and they don't incorporate any secondary deposits that are adjacent to the Arctic deposit. The study indicates a strip ratio of 6.87 to 1, which is consistent with the pre-feasibility study results. The reserves and resources are reasonably consistent with what we had in the pre-feas, although there have been some minor changes. Cash cost continues to still be very low in the first quartile at 32 cents and an all-in cost of 98 cents. And I'll have some additional comments on how those costs stack up against other producers and where they stand in terms of quartiles. We've used the same commodity price assumptions that we used in the FS, so there's been no price changes in terms of looking at these economics. They're all driven by changes that have happened with respect to our view of the project itself. Capital intensity, when we look at it on a copper production equivalent basis, is roughly $6,400 per ton, which once again is considered a low first quartile number. I'd like to point out that the FS does not include the economics associated with NANA exercising its option associated with the direct interest in the project, or if they chose to receive a net profits interest of 15%. And the FS study has been prepared on a 100% basis, of which Trilogy owns 50% through the Ambler joint venture. And lastly, let me point out that all amounts stated are in US dollars. The next slide, please. So when we look at the economics, I think the key point to highlight is that we continue to see robust cash flow, MPV, IR. The changes in cash flow largely stem from increases in capital that have happened as a result of moving from a PFS to the FS. And we'll have more comments on the specific breakdown of the capital increases. But I can certainly highlight that a large portion of those increases relate to reclamation costs at the end of mine life, and also an additional water treatment plant that has been included in the FS that was not included in the PFS. Other than that, when we look at capital changes from the PFS to the FS, it's really a result of inflationary increases from 2017 to 2020. I've indicated that the cash costs on a byproduct basis continue to be robust at 32 cents. We are looking at an IRR of roughly pre-tax 30% with a payback of 2.4 years, which is in line with what the payback was under the pre-feasibility study. Our post-tax IRR continues to be very robust at 27%, and the post-tax payback is 2.6 years. So overall, we're very happy with the results of this FS, considering the capital increases that we've seen in the project, and factoring in that there's no new resources that have been included as part of this project, whereas we believe that there's significant scope to extend mine life well beyond the 12 years that are contemplated in this FS. With that, let me turn the call over to Bob, and Bob will cover off mineral reserves and an operating overview as well. Bob?
Thanks, Tony. Good morning, everybody. The slide that's coming up next will be on mineral reserves. There will be a couple of tables that are you'll see on your screen. The first one is discussing the probable mineral reserves, and you'll see in there we've listed the PFS and FS, so you have a comparison of the changes that we've seen between the two different studies. We've had a slight increase in overall tonnage of about 1%, and then we've seen a reduction in the various percentages from about 3.5% to 5%. And that reduction is typically due to an additional 5% in dilution. So that's impacted with the new detailed design in the mine pit. We've seen a slight reduction, but overall the grades have held up and the tonnage has held up. The next table that you see down there is contained metal. So that now impacts, we've taken the impact of the increased tonnage against the decrease in the grades, and you'll see the difference that we're seeing in there really goes between 2.5% and 4.4%. So regardless of how we look at it or evaluate it, the numbers are, and the grades and tonnages are holding up. In addition, the first comment on the left-hand side gives you, we've got a little bit of inferred resources of 3.5 million tons with the grades that are shown there. Those are all along the periphery of the pit. Those are not part of the tables above, as you would expect, but there is some additional resources nearby the pit. And the bottom comment there talks about the dilution and the reduction of 2.8% that you see on the table is based on the copper equivalent calculation. So you've got the individual variance up above, and then you got a copper equivalent of 2.8%. So all the numbers are basically connecting to each other. So it gives us a high degree of confidence in the numbers we have on the tables. On the next slide, we talk about the operating overview. There's a lot of information on the slide in the different areas. First off, we talk about the mill feed tonnages, a little more detail. It gives you the tonnage. It also gives you the waste tonnages that we've got in this in the mine plan for the feasibility study. You'll see the life of mine numbers are the same at 12 years, as Tony had mentioned, and the stripping ratio is pretty much identical. On the recovery side, the second grouping down, the slide that came up, you'll see they're almost identical, subtle differences, just a lot more detail because we've gone to quarterly analysis and then annual more detail than we see in the PFS, and we had to bring in the impact of the 5% dilution on the grade. So as you can see, a 1% change, the numbers have held there as well. The copper, the concentrate tonnage in the next grouping, again, the numbers are holding in there. We've got similar numbers on the copper, lead, and zinc. Recoveries, again, as we go on the next grouping down, are very similar to what we had in the PFS for all of our metals. And the metal prices at the very bottom shows that we've kept the same metal prices in the FS as we have had in the PFS numbers. So really no material changes in the overall operating review that we see on this table.
The next
slide. Okay.
Thank you, Bob. The next two slides deal with the concentrates that we'll be producing at Arctic. And the first slide is run on the basis of, we have a table that basically shows the percentage of payable metal, which indicates that the payable metal is approximately 57% from copper, with 13% from precious metal, 26% from zinc. The quality of the concentrate is very good, and we expect that that will give us ample opportunities to market that concentrate to a number of potential off-takers and ship it through the Anchorage port, which is existing infrastructure that is already available to us. So we see the operation producing three concentrates, a copper con, a zinc con, and a lead con. We actually look at the lead con more as a precious metals con, just given that the value in that con is primarily driven by gold and silver. The next slide, provides leverage to precious metals and really indicates that at current metal prices, we see that the increase in precious metals is represents about 18% as opposed to 13% under the base case scenario. So this is important in that what we want to highlight is that on a gold equivalent basis, we're producing approximately 80,000 ounces per year on average over the life of mine, which gives us significant flexibility in terms of how we look at this operation moving forward. Back to Bob to discuss operating costs.
All right, on the slide that's up there now, we'll go through the operating costs. In there, we've got mining, processing, G&A, surface, and road toll numbers. We have seen a slight increase in the operating costs. If you take a look at the mining costs have gone down, and that's a result of some optimization with regards to mining equipment and standardization and slightly bigger gear, which results in reductions in manpower, equipment, tires, and so forth on the mining side. The processing costs have gone up by about $3, and that's due to a couple of different areas. Power costs have gone up, and I'll talk about that later on down the slides. Power costs gone up, and also water and pumping requirements have gone up. Power costs have gone up as a result of we're switching from LNG to diesel, so we've moved from about 17 cents a kilowatt to 24 cents a kilowatt. And as you can imagine, the largest power draw we have would be out of the mill between the grinding mill and the tailings pumps. And the other thing that's happened is our annual precipitation numbers have gone up by 30%. We've done a significant amount more work in the last 3 years, looking not only at overall water balances, but snowpack numbers. And the end result is we've increased our overall water balance and annual precipitation. So with that in itself, all of a sudden, pumps are going up, volumes of water are going up. So we're seeing the increase on the process side. We're also seeing an increase in the number of megawatts required to run the facility, again, for very similar reasons I just mentioned previously. And then the road toll's gone up. And overall, we've gone up about 8%. And the contributors there are the process plant and the road toll. The power costs I talked about, 17 cents to 24 cents. But we have moved from LNG to diesel for powering the facility. And overall diesel costs are similar, prices are similar to what we had in the PFS. And the table or the pie chart that you see in the lower left-hand corner gives you a bit of a breakdown of the processing costs, how we arrived at them. And as you can see, the green section of the pie, the power costs are fairly significant with all the power generation that we do have within the facility and power draws within the facility. Back to Tony.
Thanks, Bob. The next slide deals with where we stand on the cost curve, and what we've done is we've shown the numbers in two different fashions. The red star on the presentation shows if we look at just the copper production of 155 million pounds of copper per year and take the byproduct credits against the cost of producing solely copper, we end up at a 32 cent per pound byproduct credit cash cost. However, if we look at it differently, in other words, if we increase the amount of copper and assume that we have more metal that's being produced, in other words, 270 million pounds of copper, and we don't adjust for those byproduct credits, we're at 68 cents per pound. So in either scenario, we're in the first quartile in terms of cash costs on this project. So once again, it's important to stress that this project is extremely robust even at lower metal prices. And we have some sensitivities that we'll show a little later that demonstrates that this project continues to be very attractive even if we see lower prices although we have used $3 copper as the base case, as we indicated earlier. The next two slides deal with capital costs, and I'll ask Bob once again to go through those.
Thanks, Tony. The slide that you see up there next will be the one that gives you the total capital costs. It's a high-level overview. My next slide will get into more detail, but overall, there's a total capital cost, which includes initial sustaining enclosure, have gone up by 34%. The initial capital for actual construction and building of the facility has gone up by 16%, so not a significant change. Where we're seeing the difference in the numbers would be the sustaining and the closure costs. The layout itself, that drawing that you see on the center of the slide on the right-hand side, the layout really hasn't changed. The tailings facility, the waste rock facility are all in the same location. The pit's the same. We've made some subtle changes around the layout of the facility where the shops are, etc. We've moved the surface crusher over closer to the pit, and subtle changes from that aspect. But overall, there's the changes very, very small on the overall footprint what we've got for the site. The next slide gives you a little more detail. We break down the different areas within the initial capital costs. As you can see, we show you the PFS and the FS numbers there with the variation that shows up across each of the categories. The tailings has gone up, increase, but it's also been partially offset by the mining fleet. But there's, again, the annual precipitation has gone up. So we're seeing increases of costs associated with the tailings facilities. We're also seeing increases in off-site infrastructure. And the largest increase by far is the sustaining and closure costs. In the sustaining costs, we've added another water treatment plant that Tony had mentioned earlier. Also on the closure side, because of the additional precipitation, it comes back in and it gets us in every area of the operation, that we now have additional water treatment costs throughout the not only the operation but also the closure, and it impacts us throughout the life of mine and all the costs associated with it. Okay, Elaine.
Okay, thanks, Bob. Good morning, everyone. It's Elaine Sanders. I'm just going to quickly go through the tax slide. On slide number 16 here, this is a total summary of the taxes that we'll pay on the project. We have done a detailed tax model here, so you are seeing pre- and post-tax numbers. The effective tax rate hasn't changed very much federally and in the state of Alaska. Just as a reminder, when we did the PFS in early 2018, federal tax reform was enacted at the time, and we did use those updated numbers for the PFS. Pretty much legislation is intact for this project from a federal level and a state level. Effective tax rate is now moved from 24.5% to 25.7%, so a minor change. Total taxes in the table here are broken down between the state of Alaska and federal income tax. Again, not a lot of changes here. Still looking at about just under $1 billion in total taxes on a project level. And then you'll see the difference between the state broken down between the mining license tax and income tax, and then the federal income tax number. So the federal tax rate we're using is a flat rate of 21%. As you recall, the alternative minimum tax has been eliminated on the federal and state levels from reform, and pretty much the state mining tax, the state mining license tax hasn't changed in the state of Alaska. We want to just make sure you're aware that the modeling here is done on a 100% project basis only. It doesn't take into consideration any tax pools that the company may hold. All right. Thanks, Tony. Back to you.
Okay. I wanted to talk a little bit about sensitivities to different metal prices, and we've included a number of slides in the presentation that you can refer to that gives some clarity in terms of how the project does at different prices. So slide 17 shows what the metal, using copper and looking at MPV, shows that we continue to have robust MPVs and IRRs even in a lower price environment. So if we look at $2 copper, for example, on a pre-tax basis, we're looking at a 18.8% IRR. On a post-tax basis, 16.4%. Obviously, looking at a higher price environment, if we looked at $3.50 copper, for example, we see an increase in IRR to 36.1% on a pre-tax and 31.7% on post-tax. And that's assuming that we keep all of the other metal prices constant. So there's lots of variables at play just given the nature of the VMS deposit that we have. Slide 18 looks at it from a zinc perspective, and similarly there's exposure to zinc, albeit not as significant as what we have relative to the copper side, but it's clear that higher zinc prices obviously translate into higher returns for the project overall. We provided a couple of charts, slides 19 and 20, that just show the different sensitivities, not just to metal prices, but obviously to capital costs and operating costs. And I would just encourage you to have a look at those, and certainly happy to follow up with any questions from any investors or analysts on those slides. And clearly it will tie in to the information that will be filed with the technical report when we file that in 45 days. Slide 21 is a slide I want to spend a couple minutes on. When we look at the Ambler mining district, what we're really talking about is exactly that, 172,000 hectares of exploration ground. And when you look at the exploration that's happened in that area, it extends back to the 1950s. And really through the work of our previous CEO, working with our partner NANA, we were able to put this district together in 2011. And when we look at Arctic, which is the focus for our discussion today, we're really just talking about one opportunity of many within the district. We haven't talked at all about bornite and the work that we've done there. We're sitting on approximately 8 billion pounds of copper at bornite. And as I indicated earlier, we haven't factored in any of the satellite deposits or the inferred resources that Bob mentioned earlier in terms of how we look at the economics of this project. And our view is that there will be many opportunities within the district to extend mine life at Arctic. And then we can also look at additional developments at bornite and possibly other deposits in the district. There's lots of opportunities from an exploration perspective going forward, and the likely plans for Ambler Metals is to conduct significant exploration in the next couple of years as we look to further refine the plans associated with Arctic going forward. When you look at this district as a whole, and you look at the valuation, the valuation proposition for Trilogy, what you see is that we have a current market cap of roughly $287 million. On a 50% basis, we have approximately $90 million in cash that sits in the JV or at the Ambler Metal, or at the Trilogy level. And then we have half of this Arctic project that we've highlighted on a base case basis of roughly having $1.1 billion MPV, so half of that, roughly $550 million. And that's before we factor in the significant exploration potential within the district. And that's something that I want to make sure that people continue to focus on, because although we are talking about Ambler today, or Arctic today, it really is a longer-term story with respect to the district as a whole, and how we look at that district going forward. So I'd like to summarize, and coming back to slide 22, we believe the study results indicate robust economics with respect to Arctic. Ambler Metals, which is the JV entity, and we're in the process of filling out the management team there, and we expect to have an announcement shortly with respect to an appointment of a president and CEO for Ambler Metals. There are plans at the present time to roughly conduct additional drilling of 20,000 meters, 10,000 meters likely to be drilled next summer, and with 10,000 meters to follow summer after that. We're going to be looking at metallurgical work and a pilot plant to be carried out with respect to the Arctic ore body. We believe that there is a potential to feed satellite deposits into Arctic and to extend mine life at Arctic beyond the current 12 years that are contemplated in the FS and the FS results that we've looked at. As I said at the outset, this is a study that's being prepared by Trilogy, but at the same time, the consultants that we've used are very well versed in VMS deposits, and our expectation is that Ambler Metals will utilize these FS results to look at further trade-offs and optimization work as we go forward. I'd also like to point out that we expect to receive the 404 wetland permit for the Ambler Road shortly. The ROD was issued earlier this month. ADA has commenced initial work on the Ambler Road in terms of surveys and other work that they've conducted, and we have a memorandum of understanding which initially covers off a modest $1 million expenditure program on the road. But Ambler Metals has indicated that they would be prepared to match the funds that ADA was looking at spending in terms of engineering and study work of roughly $35 million. So matching that with an incremental 35 from Ambler, subject to reaching an agreement with ADA on how we move the road forward. And lastly, I'd like to highlight that we are in the process, we'll be announcing shortly a president and CEO, and then we'll be filling out the rest of the Ambler team, some of that through transfers from Trilogy personnel that have been involved with the project for many, many years, but there'll be some new hires as we move forward. So these are very much exciting times for Trilogy, for Ambler Metals, and we're very pleased with these results. And at this point, I'd like to end the formal comments and open up the call to any questions that anyone on the call has, or if you feel more comfortable sending in an email question, please do so, and we'll do our best to answer that. If we're not able to get to your questions today, please feel free to reach out. As I said, the presentation will be available on our website, and the call's being recorded, and we'll have an audio copy available at a future date. And we will be posting the study results within the required 45-day time period. So with that, I'd be happy to open up the call to any questions.
Certainly. We will now begin the question and answer session. To join the question queue, you may press star, then 1 on your telephone keypad. You will hear a tone acknowledging your request. If you are using a speakerphone, please pick up your handset before pressing any keys. To withdraw your question, please press star, then 2. Once again, to join the question queue, please press star, then 1 now. Our first question comes from Craig Hutchison of TD Bank. Please go ahead.
Hi, good morning. Thanks for taking my call. My first question is with regard to the road tolls. They went from $4.70 a ton in the pre-feasibility study to $8 a ton this time around. Can you just talk about what kind of drove that decision to increase those tolls? Was this something that was just driven by discussions with ADA?
Sure. Maybe I'll start, and then I'll hand it over to Elaine, because Elaine's been involved most closely with the discussions with ADA. It's been an evolving process. There's lots of information associated with the road, and you can go onto the ADA website where they've posted all the information associated with the Ambler Road, and talked about what the change in capital and their view of the costs were. The thing that I want to highlight first is that the road, it's a 211-mile private road. It's always been envisioned that it would be for industrial use purposes only. And I want to stress that one of the key considerations of getting this road built is that we don't want to see it impacting NANA and its shareholders' subsistent living in terms of hunting and fishing. That's a key concern within the community, and that's why it's slated to be a private industrial use road only. The road was always envisioned to open up the district, and it has an operating life of 50 years, and the economics have been put forward on the basis of Arctic, Bornite, Sun, and Smucker, but we expect there'll be other deposits that will ultimately develop. So that's a bit of background. Elaine, do you want to just talk specifically about what's changed on the toll?
Yeah, thanks. Good morning, Craig. As you know, we don't have a definitive tolling arrangement yet outlined with ADA. It's still early days, but we wanted to put something in the study because, as you know, we all know we're going to be paying some type of toll. So this is definitely an estimate. We made some estimates back in the PFS. We're continuing to talk to ADA for new estimates. And so what we've done is we've looked at what ADA's got in the public realm of what they think development costs may be for the road. If you go to their website, as Tony says, there is quite a bit of information on the road that they've talked to at their board meetings, which is all public. We've taken a look at those development costs they're estimating. We've taken a look at the users that they're estimating of the road, which Arctic is one user of others. There's 4 other projects/users that they're considering for the road. And then we've taken a look at what current interest rates are, current bonding rates, and what bonds may be. As we all know, the interest rates are really low right now, and they're forecasted to be low, but we also know that we're maybe a year or 2 out. So we've factored in some of those changes and then looked at what we think maintenance would be on the road, and that's what's driving the higher road costs in the feasibility versus the PFS. Again, very much high-level estimates. We've put through about $20 million a year annually for road tolls and about $2.50 a ton for the road maintenance, Craig.
Yeah, I think the point to stress here, Craig, as well, is that even with those increases, we still have a strong operating cost structure, and we still continue to be in the low first quartile in terms of cash costs, depending on, obviously, the factoring in of byproduct credits. So, I think it's important to recognize that, yes, we've seen an increase in tolls, but the project has definitely been able to absorb those without adversely affecting the strong, robust economics.
Yeah, that's right. And I know my geology friends always tell me grade is king, and I think that's because Arctic has such grade that it can absorb higher operating costs.
Thanks for that. Maybe just one last follow-up question. Just in terms of the path forward for Arctic, can you just give us a kind of high-level overview in terms of how you move this forward into the permitting process and maybe some milestones you're looking for in the next sort of 12 months on that?
Yeah, that's a great question, and I think it ties quite nicely into what I had indicated earlier, which is the imminent announcement of a president and CEO at the Ambler level. And Ambler, as I indicated, is a 50-50 JV between ourselves and South 32. So we're going to have an independent management team. When the JV was formed earlier this year, we've put people in there on an interim basis, some people that have been sourced from South 32, others that have been sourced from Trilogy. But now that we're building out the Ambler Metals team, we'll have an independent team that will bring forward their thoughts on how they see the project moving forward. I think the key factors and the key items to focus on over the next 12 months will be the progress on the road in terms of the engineering and the next steps in terms of how that moves forward. That's going to be extremely important. The field work that needs to be carried out next year. We had obviously hoped to be in the field this year, but because of coronavirus, we're in a situation where we couldn't safely justify having a very limited field season, and we looked at the work that needed to be done this year and felt that it could be deferred till next year. So next year, we're looking at probably about 10,000 meters of drilling. So that's going to be an important consideration as we go forward. And then it's really about taking this work that's been done, this fine work that's been done in this feasibility study, and providing it to Ambler Metals to incorporate in terms of how they look at optimization work and studies associated with the project. So we think that this actually supplements a lot of the work that we expect Ambler Metals to be doing in the future, and we expect that this will go a long ways towards helping the next steps that need to evolve. But the key milestones, Craig, are really going to be the focusing on the road and engineering work that needs to be done, and the next step with respect to the field season. With regards to permitting, that's something that we'll be discussing with the Ambler management team once they're in place.
Great. Thanks for taking my questions.
Yeah, thanks.
Our next question comes from Joseph Rager of Roth Capital Partners. Please go ahead.
Morning, guys. Thanks for taking my questions. I guess first thing, obviously a lot of the changes that just appear to be the standard, jump from a PFS to feasibility study. But, how does, your partner, South 32, feel about it? I know they weren't part of the creation of this document, but I'm sure they've seen the numbers. Did they give you any initial reaction?
Well, they haven't seen the numbers, Joe, just to be clear. And, as I said at the beginning, the history of this study goes back to, Trilogy having to sort of think about what was going to happen in the future. And unfortunately, we didn't have a crystal ball at the time of knowing whether South 32 was going to exercise its option or not. And so we wanted to be in control of our own destiny, and we felt it was important to launch straight into a feasibility study after we had the positive results on the FS. I can't really speak for South 32. What I can say, though, is if you sort of follow their wallet, they've invested $30 million in exploration initially. Based on the work that we did, which they had access to on the pre-fees that they were able to review and critique and consider, and they've had a lot of their people on site and quite involved in terms of doing due diligence on the project. They were prepared to invest a further $145 million into the creation of a JV. So I think all this does is really validate the work that was done under the PFS, and I think it sets us up well for moving into the next phase of development with respect to Arctic. And I think more importantly, it underscores that Arctic is just one of many opportunities that exist in the district. I think the most significant development that's happened in the last several months has really been the record of decision on the road. And if you think back to how long a process that had been and how long it's taken to get to where we are, it's extremely positive. And lastly, the other thing that I think is important to stress is we talk about our partner South 32, but we haven't really talked about our partner NANA. And NANA is a key player in this process, and we have to make sure that NANA is comfortable with how we move forward in terms of next phases of development and how this project moves forward. And I made a point of stressing that the road's a private road, that there's sensitivities associated with caribou migration, that there's sensitivities associated with hunting and fishing in the area, and we're very, very mindful of those things. So those are the factors that we're thinking about. But I think we're very happy with the work that's done, and I think, as you point out, there's a little bit of noise that you see from a PFS to an FS, but the study's held together pretty well. And we'll pass this on to Ambler Metals, and South 32 will have ample opportunity to share their views as it moves into the Ambler Metals area of management.
Okay, fair enough. And then I guess, a lot of different numbers that move, but I guess the one that jumped out to me was the sustaining capital was probably the biggest part of the capital that jumped. You guys gave a little color on it, but any more color you can give there, just, what maybe the 2 or 3 biggest pieces of that jump are?
Sure. I'll flip that one over to Bob, but the biggest piece was the water treatment plant that comes in towards the back end in the feasibility study, towards the back end of the mine life, which, I think it's important to state that because even with not just the water treatment plant, but with the reclamation cost, we're looking at a 12-year mine life right now, 8% discount. Not a lot of that impact actually has an impact on NPV or IRR, just given 8%. But if our view is correct that we'll be able to find other material to process through the Arctic mill when it's up and running, it just underscores how that impact becomes less and less in the future. But maybe Bob, you're in the best position to comment on the changes to sustaining capital.
Okay, thanks, Joseph. Yeah, as Tony mentioned, one of the biggest impacts is the additional water treatment plant that we're putting in at the closer towards the end of the mine life. The other one, I go back to it again, is the precipitation by going up by 30%. So as soon as we increase it by 30%, all our chemicals, reagents are increased, so our annual operating costs are going up, pipelines are increasing, power draws increasing, and now instead of in the previous one, we had one water treatment plant running right at the end of the mine life. We've got two water treatment plants, although selenium plant only runs for about 15 years, and after that we can shut it down. But so we have it's precipitation, water treatment, and double operating costs and power costs for the sustaining capital.
Okay. Then one final thing, just big picture. You got this feasibility study behind you. You got the ROD on the road. How do you see the timeline to a construction decision?
Yeah, I think what we're going to do is we're going to take this study. We get the management team in place at Ambler Metals. This information gets fed into there. As I said, the next steps are going to be really associated with the additional field work that we need to do and looking at optimization of the work that's been done to date. I think from a timeline perspective, as you look at past presentations from Trilogy, we've talked about potential 3-year time horizon on the road, and then a mine construction decision at some point that could be a further 3 years. I think the question, of course, will be when does the permitting start, and can you do that in conjunction with the work that's being done on the road, and so how does that all fit together? That's how we're sort of looking at things. The good thing from an Ambler Metals perspective in terms of the work that we need to do for incremental drilling, optimization, study work, Ambler Metals is well funded. As you know, when we created the JV, there's roughly $145 million sitting in the JV, so we're in a strong position to be able to look at things. I think the one thing that we're waiting for is the last 404 permit, and then I think the next steps that Ambler will be focused on will be working with ADA in terms of further facilitating our agreements on working together on the engineering associated with the road, and hopefully increasing the amount that we're prepared to fund on our side and ADA is prepared to fund on their side to move a road forward, and then looking at nailing down the toll costs on a more comprehensive basis in terms of how we look at funding. So those are the big catalysts that we see. We think exploration is going to be key to the district, and we're really focused on how we're going to look at the larger picture of the Ambler mining district. And I think part of the optimization that we're going to consider is how does Bornite fit into the Ambler mining district as a whole in terms of potential development there. But then, as I said on numerous occasions, how do we feed more material from some of these satellite deposits that have been identified into Arctic, which already has robust economics on a standalone basis for 12-year mine life. Can we look at it over a longer mine life, and how does the processing play itself out? Is 10,000 tons per day the optimal processing rate, or do we look at something different? I think those are the big things that we're focused on, but we're very excited. Metal prices are moving in our direction. We think that the results that we presented today are are very good in terms of the next steps that Ambler Metals is going to be taking with respect to not just Arctic, but the district as a whole.
Okay. Kind of a long answer. Just kind of a question on summing that. I guess, is it fair to say that there's a wide range of breaking ground that could be anywhere from, call it 2024 to 2026?
I think that's very fair, but I think that there's the critical factors are going to be the road and when we're in a position to start permitting, and those are decisions that are going to sit more at the Ambler Metals level. So it's hard for me to speculate as to whether it's earlier or later of that time period that you highlighted.
Okay. All right, I'll turn it over. Thank you.
Thanks.
Our next question comes from Stefan Ioannou of Cormark Securities. Please go ahead.
Great, thanks, guys. Yeah, great to see the study still, generating some pretty positive economics. Just, without the minutia of the actual tech report in hand, just curious on the grade profile. Has that changed much from the PFS, or is the mine plan, aside from the modest dilution that you mentioned, is the same sort of sequencing and planning with regards to head grade, sort of give or take the same going forward?
Yeah, Stefan, great question. Bob, do you mind addressing that?
Sure. Yeah, Stefan. No, it's pretty darn close all the way across the board, whether it's tons or grade. For the first, we've gone into more detail, obviously. We've broken it down into quarterly numbers for the first 5 years and then went annually out there. There's very little change. One of the things that did change slightly, and you see it in the way the waste distribution is on an annual basis, is that we've laid a couple of our slopes back a little bit more due to the talc. So you'll see our waste profile has gone up in the earlier years compared to the PFS, but overall tonnage grade going into the mill is as close as these percentages we're looking at those tables. So that was a real nice result of the additional detail, and even with the larger equipment that we're looking at in the pit. So it stayed fairly similar. As you can see, it doesn't change from the tables.
Okay, great. And when you mentioned, next summer another 10,000 meters, I think you said at Arctic, is that, largely geotech type of drilling and stuff, or do you see an opportunity there to sort of zone in on some even higher grade zones or change the mine plan again, or what's sort of the focus of that 10,000 meters?
Yeah, that's I think, Stefan, we've acknowledged that there's probably 20,000 meters of drilling that needs to still happen.
Okay.
And clearly we'd like to see an opportunity to look outside of Arctic, but there is metallurgical drilling that needs to happen at Arctic. So that will likely be the initial focus, but obviously to the extent that we can mobilize additional drilling, and we can do that within the confines of the camp that we have and the resources that we have available, and hoping that coronavirus isn't as a significant issue as it was this year in terms of getting ramped up, just given the timing. We're clearly interested in looking outside. When I say we, Trilogy is clearly interested in looking outside of Arctic, but we believe that probably dovetails well with Ambler and South 32's views with respect to looking to find supplemental material that could be fed into Arctic longer term. So we'll have a better sense of that once we sit down with the new management team.
Okay. And maybe just, one last question from me. Just on, we're talking about sustaining costs before, but, then it sounds like the bulk of the sustaining cost, sustaining Capex was the water treatment plant towards the end of the mine life. But then you mentioned, obviously closure costs are up significantly too, and there's some ongoing water treatment costs post-closure. But just wondering with the, beyond just water treatment costs, why the closure cost as well was up significantly. If you could just give me a little bit more light on that.
Bob?
Yeah, the closure costs, we've got sustaining costs. So part of that second water treatment plant is coming in on year 11, so it shows into the sustaining. costs, which is takes us from that 65 to 113. And the closure cost, it took me a while to come to grips with it as well. The actual physical dismantling of the plant and removing it is almost the same as the PFS and FS, and it really is the water treatment, the high density sludge, the selenium treatment plant, and the cost of piping and pumping to because it's a seasonal. You know, we do the water treatment from April through to October. We move crews in around April and out in October. So you're moving people in, you're moving people out, you're starting up camps, shutting down camps, and I struggled with it as well, Stefan, and we went through it a couple of times, and it really gets back to the water treatment after closure.
Okay, great. Thanks very much, guys. Good case study.
Thank you.
Thank you.
Our next question comes from Brian MacArthur of Raymond James. Please go ahead.
Good morning, and thank you for taking my questions. So I apologize, both my questions have been asked, but I just want to flush them out a little bit. So just following up on Stefan's, I'm surprised at the 205 as well. Can you just clarify that water treatment? Is that like over to maintain water treatment for another 50 years? So like the discounting of that 205 is stretched out over a very long period of time. Is that what's happened? So like you've got years and years of just higher costs, or is this more like short term or something? I'm just trying to follow up on his question, get a little more detail on exactly what's in there, since we don't have the tech report.
Sure. So high level, there's obviously the construction of a plant, and then there's the operation of a plant that occurs over a period of time. And what's happened is we've used the discount rate to look at what those costs are in terms of discounting the water treatment costs, and then brought it back using the 8% discount. But Bob can give you a bit more color over the timeline and how it stretches out. Bob?
Yeah, what we did is we took a conservative approach to it, and we actually looked at it over 100 years, and we discounted it back to year 13. And about every 25 years, we've got a complete change out of pipelines, plants, power plants, major upgrades, and then we discounted that back to approximately year 13.
Okay, thank you. That's very helpful. That clarifies that a little bit. And then the second thing, just to follow up, my question on the road is kind of the same. And I take it your point, the economics are still very good, and I take your point, it may change. But you also made a statement talking about you looked at Arctic and Boronite, and I think Smucker and Sunshine when coming up on the amortization. So again, have we just assumed that whatever rates you decided, were you just allocated it over 12 years, or are you taking a lower rate because you think it's going to be extended? Or I'm just trying to figure out exactly what you did. You sort of said something about $20 million a year and then $250 maintenance. Can you just go through exactly a little more detail what assumptions you were making there? I'm just trying to figure out what might actually change going forward as you actually work through this.
Yeah, sure. And I think Elaine gave you what the numbers are, and the way we're sort of looking at it is that the final toll payments still need to be negotiated with ADA in terms of the access road, and that's going to occur at a future date because we haven't had those discussions. So for purposes of this study, we had to assume that a toll would be paid on the Arctic project being one of 4 potential projects that had been identified by ADA that would use a road. And those 4 projects are disclosed as part of the process and the EIS. Other work that's been done, they're Boronite, Smucker, Sun, Arctic are the 4 projects. And based on those, so what we've done is we've come up with looking at the resources of what's out there and taken a pro rata approach to figuring out the portion that would accrue to Arctic. And as a result, from a Trilogy perspective, what we've estimated is that it would be about $20 million a year would be the direct toll costs over the 12-year mine life. Obviously, if a mine life extends, then that toll will extend even further, obviously, than the 12-year time period, which is our expectation. And in addition, we factored in $250 a ton per ton milled, and that's what we use to look at those costs. So we had to come up with some basis, being in a situation where those discussions in terms of detailed negotiations and discussions haven't happened. That being said, I can say that we're not running blind, and that we recognize that Ada is going to be our partner in terms of the development of a road, and we wouldn't have put any numbers out there with at least having a discussion, without having a discussion with them in terms of a reasonableness of what we're trying to get at. And I would say it's a marked change from how we had looked at the road in the PFS, and that's why you're seeing the increase in the road costs associated with the project. I hope that helps.
No, that helped a lot. That's very helpful, Tony. And just the other assumptions, I assume you assumed that you didn't put any more capital in the road, which might reduce the toll going forward, right? Is that a fair comment?
Yeah, I mean, we're contemplating, or Ambler Metals is contemplating funding $35 million, which is the matching amount that is being contemplated by Ada, and we haven't factored any of that in. In fact, the way we've looked at the FS is that all of the cash that's sitting in Ambler right now, we assume that money's spent, and it's not factored into any of the work that we're doing here in terms of the FS. So to the extent that any of those funds are used to fund, part of a capital associated with the development of a road, then we would expect that toll amount to come down to reflect that we've pre-funded some of that.
Great. Thank you very much. Very clear, Tony.
You're welcome.
Once again, if you have a question, please press star, then 1. Our next question comes from John Tumazos of John Tumazos Very Independent Research. Please go ahead.
Congratulations on the feasibility document. That's a big job.
Thank you.
Are the satellite exploration opportunities all within the JV with South 32, or any of them 100% owned by Trilogy?
They're all within the JV with South 32.
How much is the road Capex outside of your roughly $900 million project Capex?
So the road Capex is, it's varied, John. We've seen different numbers that have been put up by Ada. When this process started a couple of years ago, they were talking about a cost of $350 million, then it moved to $450 million, and I think they've got a range there now. It partly does depend on what road is going to be built, and what Ada has contemplated is a 2-lane road, gravel, private, as I indicated previously, all weather, all year road. And what we're assuming for Arctic, at least initially, is that it will be a single-lane road with pullouts. So we've sort of assumed, I think, somewhere in the neighborhood of $350 million as what the road construction would be for that single lane with pullouts. And as we indicated, on an undiscounted basis, we're looking at $240 million being spent on the road by or funded by Arctic as part of the numbers that are included in the FS.
Thank you.
You're welcome.
Concerning the move to a diesel plant, are there cost reduction opportunities moving to another energy form? Or environmental social governance issues are very important now to many companies. Could diesel, I guess I'm concerned that over several years, regulations change, governments change, carbon taxes, whatever happens. But for some companies, they might prefer it be another energy form. Lots of companies are beginning to study solar to hydrogen. Clearly, you can't have a solar plant in Alaska, but you could have a solar farm in the Pilbara and export liquid hydrogen, for example. What are the flexibilities of moving in and out of diesel?
Yeah, it's a good question, and you know, I think in the original PFS it was assumed that we were using LNG, and what we've looked at is just the delivery of LNG and availability of it, and how those costs compare to where diesel is right now. So that's the move to diesel. But I believe we're looking at a dual fuel plant. Is that right, Bob?
Yeah.
Yes,
Yeah,
we do have the option of looking at a dual fuel plant. Yep.
And I think, you know, in terms of other energy options, I think you're correct on solar. That would be tough. There likely will be the possibility to look at wind and perhaps even run-of-river power to the extent that that's available in the area. But I think those would be things that we would want to consider. But I think we'd want to carve out as much flexibility as we can with respect to a dual fuel option, just for the reasons that you pointed out.
When you say dual fuel, do you mean LNG versus diesel, or all sorts of flexibilities, run-of-river, solar, hydrogen if the technology evolves, et cetera?
Bob?
When we're talking dual source, we're looking at the actual generators themselves. They are available. They can operate under LNG and diesel. We've talked about alternative sources, and maybe we can use them for the camp facility, for argument's sake, where it could possibly be windmills. But we really, other than just a general conversation as the project advances, the dual source generator has been our biggest discussion point at this time.
Thank you very much.
You're welcome.
This concludes questions from the phone lines.
Great. Operator, thank you very much. I wanted...
Yeah, just a couple of questions from my end. One is why we're switching from LNG to diesel. I think that was just answered. And then maybe Jim Gowans can jump in and question regarding, you know, how the AMDF project compares to how they permitted and developed the Red Dog Road.
Yeah, Jim, you hear that question?
Yeah, I did. Can you hear me?
Yes.
Yeah. So when we did Red Dog, when I was managing the engineering Red Dog, it was a similar thing, except for we did the engineering, construction, and built and everything, the road up to the process plant and the mine at Red Dog. And Ada financed it. It was almost, we had already completed the engineering and before they came involved in it. The road to the Ambler mining districts is going to be a bit more of what I call a hybrid model for working with Ada. Ada will still be the primary financing, and it'll be done on a toll structure, which is what they do at Red Dog. The Ada still probably makes over $25 million a year on their tolls for the Red Dog processing road and down at the port facilities. This one, the Ambler mining district, will be slightly different. We'll probably contribute a little bit of capital up front to accelerate the engineering and get that going, and then it'll roll into more traditional tolling structure at some point. I hope that answers the question.
Great, thanks, Jim. I think we've concluded with all the questions that we have, both people calling in and online submitted questions. And with that, we'd like to conclude the call. I'd like to thank everyone for joining us for the update on the Arctic Feasibility Study, and we look forward to providing future updates in terms of the next steps associated with not just Arctic as a whole, but the Ambler Mining District, and want to thank everyone once again for joining us. Thank you.
This concludes today's conference call.